Every year, 40,000 visitors from around the world make the annual pilgrimage to America's Omaha, Nebraska to attend the Berkshire Hathaway Annual General Meeting, or otherwise known as the Woodstock of Capitalism. The AGM is hosted by one of the world's wealthiest men and CEO, Warren Buffett, and co-hosted by his longtime business partner, Charlie Munger. Everyone from hedge fund managers to individual investors to the who's who on the Forbes rich list flock to this event to try and gain some investment wisdom from the oracles, Warren and Charlie. Prior to this event, many, like our own financial planner Sean Gilbert, attend an executive course at the prestigious University of Nebraska called The Genius of Warren Buffett and the Value Investing Congress. So, Sean, having just come back from the Genius of Buffett course, what was the biggest insight that you took away from your week of learning?
Probably the most important thing I got out of the Buffett course was the importance of management. Ideally, you want a manager or CEO who is passionate about the business and would secretly probably work for free. The difference between having a manager like this and your typical manager who wants their stock options to rise is huge. One of the analogies used was that buying a business without the management is like buying the Eiffel Tower without the elevator. The toughest part about evaluating management is that it's the one part of business valuation that you can't get from the numbers in company reports. It's qualitative, not quantitative.
Now, Sean, you were privileged enough to view some of Warren's private files on various transactions, which have never been released to the general public before. What can you tell us about the ratios that were commonly applied when he was analysing these companies?
Firstly, we want a return on equity of 15% or more. Ideally, you want to have a growth rate of at least 6% above inflation. When you buy a business, you are basically buying potential earnings or profits. We looked at a number of Warren Buffett's deals from the past. In many of these, he had paid only 7 times earnings, that is, a PE ratio of 7. This is a lot lower than the current PE ratio of the Australian stock market, which is around 16, or the US stock market, which is almost 24. So Warren was getting a very good deal. And that is the other important part of Warren Buffett's valuations, the margin of safety. That is, the difference between the value you think it is worth and the price that you will pay. Business valuation is an art, not a science, so we need to leave a margin for error. We ideally want a margin of 33% or more. Otherwise, there is too much possibility for error.
Sean, you also had the chance to meet a lot of Warren Buffett's CEOs and managers firsthand at this event. Can you tell us some of the insights that you gained from hearing them speak?
The main thing was the importance of business culture and management. All of the managers were very humble, honest, passionate, and with a very high degree of integrity. The fact that Warren Buffett has never lost a CEO to a competing company says something about the culture of Berkshire Hathaway and the people they identify to be managers. The other point was the importance of maintaining the culture. All of the businesses and the board of directors spend a significant amount of time on succession planning, and there is always a defined plan for who will take over management at each company if a manager dies, leaves the company, or is fired, for example.
Sean, as we know, the Berkshire Hathaway AGM is a massive event. What was one of the most pertinent pieces of information you felt you took away after hearing Warren and Charlie speak?
You hear a lot of noise in the financial media about macroeconomic factors. Warren and Charlie don't worry about these factors, as they freely admit that they don't know what is going to happen to oil prices, interest rates, unemployment, or even who will be the next president. They just look at a business, its earnings, its industry, and its management. They evaluate what they think earnings will be in the future, they calculate a price for what they think the business is worth, and they compare their price with the price that the market is offering. And of course, you want to pay a lot less than what you think the company is worth.
AJ Financial Planning is committed to sending our team around the world to events like this to seek the latest investment ideas, training and trends. We believe strongly this point of difference sets us apart from others and keeps us ahead of our field. AJ Financial Planning is a small firm with big ideas for our client. To finish on a quote, as Warren Buffett famously once said, "Risk comes from not knowing what you are doing." So, put your financial dreams and aspirations in safe hands and speak to our team at AJ Financial Planning.